Hello, eTorians. I'm Callie Cox. I'm your US Investment Analyst, and I'm here today to MC our monthly, I believe it's monthly, club and client webinar for all of you. You usually see Danny Vega up here. He's taking a well-deserved vacation. So I'm here with Davis Gaynes. Davis, how's it going?
It's going great, Callie. Very happy to be here and meet eTorians.
Yeah, hi, welcome, Davis. It's Davis's first webinar, by the way. So you're in the club, friend. Yeah, all right. So Davis is going to be here to talk to us a little bit about options. Give us the 101 on what options are, what eToro options are, and all the fun ways that you can use them in your portfolio. So I want to go through a few housekeeping items before we kick it over to Davis. So just give me a few seconds here. So very important. First of all, hi and welcome, but also, can you download this content later? You can, but it takes a few days to about 2 weeks to process it, hopefully on the shorter side. So just keep that in mind. You can download this after the webinar. It just takes a little bit of time to process. A little shout out here, please fill out our survey after the webinar. Tell us what you liked, tell us what you don't like. We want to hear all of it, but please, please, please fill out our survey. Send us feedback on this. That's how we get better. And lastly, ask us a question. Ask me a question, ask Davis a question. We'll be doing live Q&A toward the end of the webinar. So please don't be shy. Drop your questions in the chat. Or if you have any questions about the webinar after the fact, you can always reach me at callieco@etoro.com. And most importantly, I can flip the slide. All right, our disclaimers. Compliance and legal are telling me to say this, so I will, but please take it seriously. Anything we say here is not investment advice. It's not a recommendation. We don't know your personal portfolio, your needs, your goals, your wants, your desires. Seriously, though, we cannot give you investment advice. Please don't take it this way. All trading is speculative in nature, and it involves substantial risk of loss. For the return you're hopefully getting, you're going to be taking on some risk as well. And then, as always, past performance does not indicate future results. Very, very important to remember. Keep that in mind as we go throughout today's presentation. And now, the fun stuff. So, y'all, I want to give you a really quick introduction to Davis. Davis is, like I said, he's new here, new to eToro Options. But he's a co-founder. He's a co-founder of eToro Options. He's a fintech veteran. He has more than 25 years of experience, both in senior management positions and in consulting with fintech firms. He actually started at the OG fintech on Wall Street, Instinet, and now he's made his way to eToro to help us all understand and learn how to use options for a bunch of different reasons, for a bunch of different objectives in our portfolio. So Davis, I actually flipped to your first slide, got it kicked off for you, but I'll let you take the reins from here.
Terrific. Thanks so much, Callie. Appreciate it. And I'm really excited to be here. eToro Options is new to the eToro platform. And today we want to basically give you an understanding, particularly for those of you who haven't traded options before. And to do so, we're going to ask and answer 3 questions. What are they and how do they work? How do people use them for investing? And specifically, how do people use eToro options? So let's get right into it. What are options and how do they work? An option is a derivative. A derivative, as it sounds, is derived from an underlier. And in the case of the options we're talking about, the underliers are US equities, stocks, and ETFs. A derivative is also a contract. So when you buy an option, you're really buying an option contract, which is an agreement to buy or sell a stock or an ETF at a specific price within a particular amount of time. And note, it's not an obligation to do so. It simply gives you the right to do it. And that's why they call it an option. It gives you the option to turn that option into the actual shares of stock, or if you're a seller, to actually sell the stock. The benefits of option trading, there are a lot of them. 2 of the very high-level ones that most people would think about are, 1, it gives you leverage. An option allows you to spend less money on an investment to get, for a relatively low upfront investment, for the gains that you're looking for. And options are high risk and high reward. They're a more complex instrument. Derivatives, by definition, are. And options also give you the ability to create trades that are bullish and bearish. Now, of course, with stocks, buying a stock is bullish and you can short stocks, which would be bearish, but shorting stocks are really risky and really expensive. So options are a much less expensive, less risky way to do so. Some of the key terms, and we're going to start in the middle with calls and puts. There are two main kind of options that you care about. A call is the kind of option you buy when you think a stock or an ETF is going to go up, and a put is the kind you buy when you think it's going down. And these terms, options are really deep and really complex. What we're going to do today is we're going to touch on high-level, most important terms that'll give you 80% of an understanding to start deciding, do you want to try them or not, and get an understanding of exactly how they work. So we're really going for the most important terms. So call and put, critical. On the left side, you see the term strike price. When you buy an option, you're going to pick an option strike price, and that's going to be the price you think the stock might get to. On a call option, it'll be a strike price will be above the current price of the stock, and on a put option, generally it would be a price below the current price of the stock. Below strike price, we see premium. Premium is the price you pay for the contract. So when you buy that option, it's going to cost $100, $1,000, whatever the number is. That investment is called your premium. And that generally is the most you can lose on an option. There are some edge cases where you can lose a little more, but generally, when you spend your premium, that's your investment. And again, the risk reward, you can lose the whole thing, or if the option goes in the direction you hoped it would, you can have a nice substantial return. And on the right side, we see an example, July 17, of an expiration date. When you buy an option contract, you buy it to fit a particular time frame in which you think that the stock or the ETF is going to move the way you want it to. It could be literally the day you buy the option, it could expire that day, or it could be out a year or even 2 years. So the expiration date is the date by which you think the event will happen that you think will move the stock. Those 4 terms or 5 terms, that's a good chunk of what you really need to know to start getting comfortable with option trading.
Oh,
there are a few more terms. Yeah?
Can you go back a second? I just want to make sure that the listeners digest what you just said. So
absolutely.
We have all these terms here, guys, thinking about what it means. So the premium is what you're paying to make the trade. The strike price is the price that you're eyeing for the security or index that you're investing in, where you think it's going to go over, X amount of months, days, years. And then the expiration date is basically where the trade ends. It's where you need to reach that stock price or the option expires.
That's exactly right.
Am I getting it right? Good. All right. Amazing.
Thanks for that. All right. So in the money and out of the money are terms you'll hear quite a bit. So let's take an example. We'll stick with this example throughout. Let's say we have a stock price at 100. We'll call it XYZ. If you buy a contract that's a call option that you think it's going to go to 110, when that stock price gets above 110, you're now what we call in the money. So in the money means the option has hit your strike price or above, which makes it become a profitable trade. Out of the money is anything else. So if the stock is at 100, I buy the call option for 110, and the stock gets up to 105, I'm still out of the money. I'm closer to being in the money, but I'm still out of the money. So an important term, and important when we talk about pricing of options, because the closer you are to being in the money, or if you actually buy an option that's in the money, you think about it logically, it means it's going to be more expensive. And if you're way out of the money, if you're buying that $100 stock option up at 140 or 150 and you need a huge move, you're way out of the money, but it will be a less expensive contract to buy. So in the money, it's in the money past the strike price you've chosen. Out of the money, it hasn't yet hit that strike price. And we talk about calls and puts. On the put option, where you think the stock is going to go down where you're bearish, the example would be the stock is at 100 and you bought a put at 90. You think the stock is going to drop. When it's at 95, you're closer but not there. You're still out of the money. And then once it gets below 90, 89, for example, you're in the money. So again, all of this is fairly complex the first time you hear it. It's kind of in one ear and out the other. But the more you hear it and the more you start to practice, as we'll talk about, the more comfortable you get with the terms. The Greeks is one of the really complex terms that we're not going to get into except for a couple of seconds right now. But because options are complicated, and there are many of them, there are very complicated pricing models that the market uses to come up with the value of an option at any point in time. And the Greeks are measurements of change, which are used to help determine the market price of an option. There are numerous models, quantitative models that price options, and the Greeks are key inputs. Now, when we talk about pricing options, there are a lot of factors that go into that. One of the really key factors is the price of the stock relative to that option you're buying. So for example, if it's a $100 stock, the 110 call option will cost less than the 105 option, because the 105 is closer, it has a shorter distance to go, it's more likely I would hit that than the 110. So the relationship between the strike price you choose and the underlying stock is critical. The Greeks, as I mentioned, are measurements of change. They're critical. Volatility, what that stock typically does, how often it goes really high, really low, or if it's a little more steady, that'll have an impact. Supply and demand, when a lot of people want to buy anything, that will make that something more expensive. So many factors go into option pricing. And I want to mention again real quick, we're just going to mention it once today, the idea of a spread option. A spread is when you have a combination of two or more options on the same stock. It can be two calls, it can be a put and a call, it could be two puts. It's more complex, a little harder to get your arms around because there are two of them, but it actually lowers both risk, less likely you'll lose all your money or lose as much money, and lowers your reward. It puts a cap on how much you can earn. Spreads are used by many, many sophisticated investors. So if you get comfortable with puts and calls and trading options in general, spreads is something you might want to look at next.
So Davis, and I know we don't want to get too far into spreads. That's kind of, that's for the Options 201 course. But tell me an example of when I would want to use a spread. Like make it make sense to me.
Right. So for example, one spread, it's called a debit spread because I'm spending money. A credit spread means I'm taking in money. On eToro options, we only do the debit kind where you spend money. I could buy a strike price call at 110 and I could sell one at 105. So I'm spending a bunch of money to buy that 110, but I'm getting money back from the one I sold at 105. Now there's a $5 difference between those strike prices. So my investment will be much less because the premium I'm spending is less because I'm getting money back, but my maximum return will be the $5 difference between the call that I sold and the call I put. So I still want it to go up, I'm still bullish, but I'm spending less to put on that spread trade than if I had simply bought the single call option.
Gotcha.
Make sense?
So, I think so. So it's basically adding another part to the trade to make it cheaper on the front end.
That's right.
But then you're giving up some of the potential return on the other end.
Exactly.
Less risk, less return.
Exactly right.
Okay, I'm seeing it now.
Another spread, just for fun, is if I'm not sure which way a stock is going to go, but I'm pretty darn sure that once earnings come out, for example, it's going to move a lot because I know a lot of people are paying attention to it. I can buy what's called a straddle. A straddle is when I buy a call and I buy a put. So if the stock doesn't move, I'll probably lose on both of them. But if the stock moves up a lot or down a lot, the idea is to make more money on the direction that you were correct on than the cost of the other option that you were incorrect on. And we could have 10 sessions just on spread trading because there's so many different combinations and permutations to go through. But those are the general ideas, and they're kind of fun if you like to play with things like this.
Yeah, I don't want to like throw it too far off, but I do know there's a spread called an Iron Condor, and that just sounds incredibly epic. So.
We're not going there today.
I know. But great explanation. Makes total sense. And
Good
by the
deal.
way, if anybody has questions, please drop them in the chat. Davis will answer your questions.
Absolutely. All right, here are just a few other things to know when we talk about options. One of them is that options trade just like stocks do. They trade on an exchange. They trade all day, every day when the exchange is open. So just like you might pick up your app to check on a stock price, you'll also have the ability to check on your app for an option price. And by definition, just like stocks move all day, every day, options move all day, every day. So we talk a lot about when it expires and whether or not you make money, but selling options, you can do it anytime. So if I buy a call option today for that stock that's at 100 and I bought the 110 call and I bought it out 2 months, but in 2 weeks, the stock has moved all the way to 115, I can just sell that option. I'd have a nice profit, the difference between the 110 and 115, and I would be done with that trade. So even though you bought it and you might buy that expiration date way out a few months, you can always sell a position you've bought. And conversely, and importantly, if it goes against you, if it didn't do what you thought it would and it's worth half as much as the day you bought it, you can get out. You can take that half of your investment and reinvest in something else. You don't have to hold it and watch it go to zero. So that's a really, really important thing. A lot of people don't think about that. But if it didn't do what you thought it would do, don't be shy about selling it, take some loss, and live to use that money in another trade. Liquidity is something a lot of folks might not think about, but it can be important when trading as to the trading cost and your ability to get done as many contracts as you might want to. So basically with liquidity, we're talking about how much is trading in a particular instrument. So when something trades 1 million shares a day of a stock, for example, that's pretty liquid, and it's usually a very tight spread, the bid and offer spread, so it's not expensive to buy it and then sell it, and it's usually easy to do a good-sized trade. Now, one of the interesting things about options are there are literally hundreds and sometimes thousands of option contracts tied to just one stock. So very often options are not liquid because no one is trading that option. So one thing you want to take a look at trading options is which ones are liquid. And generally you'll know that when there's a tight spread, that's one good indicator that it's liquid, because you're better off buying a liquid than an illiquid option. And again, you really can't tell till you start digging into the trade itself and you can look up the data. But this is something to keep in mind because when they're illiquid and they have that wide spread, it costs more money than you really want to invest just to buy it and then sell it later. And then finally, setting up a trade. Everything we're talking about is thinking through first, what do I want to invest in? What do I think is going to happen? And second, executing the trade. So before you can think about executing the trade, before you think about putting it into the market, you basically want to ask and answer a few questions yourself to set the trade up. What is the stock or ETF I'm interested in? Which direction do I think it'll go, up or down? When do I think it'll move, right back to the expiration date? And how much do I think it'll move, back to your strike price? So the idea is for you to have asked and answer these questions before you actually come to the table to put that trade up.
So Davis, are options available on any stock or ETF that I could ever dream of or own?
Definitely not. They are available on most. There are relatively few stocks, more ETFs, but relatively few stocks where you won't be able to buy an option. I don't know, probably 99% of all the stock trading volume, those stocks have options attached to them. But there are definitely small cap names that do not have options. And you'll be able to tell just by going into the app and putting that option ticker symbol for the stock in. And once in a while, yeah, it might tell you, no, we don't have an option on this one.
Gotcha. So while we're on the subject, we have a question from a listener or from a viewer, Randy. Hey, Randy. So Randy asks, because timing is critical, we all just heard you say that, Davis, does eToro have instant executions?
Yeah, our execution is very fast. I don't know how to measure instant, but basically for any broker, we have what we call a routing engine. And as soon as you put your order into the system, it gets routed directly to the other side of that trade who executes it. I think from what we've heard from our customers historically, we are very quick and we're right spot on compared to other broker dealers like ourselves. But that is a tough thing to measure. And obviously it does change with respect to market conditions. But that's a sort of thing as a broker, if you want to be top tier, as we believe we are, you have to be good at that. That's really important. Good point.
Yeah, great question, Randy. Drop your questions in the chat. We'll answer them.
Okay, so let's talk a little bit about strategies. How do people use options? What are they doing with them? And the good news here is you can really put it into two buckets. Basically, options are used for hedging, investments you make to soften the blow of a sell-off in a single stock or portfolio you own, kind of like insurance. And I would mention hedging is used tremendously by all types of professionals in this business. And one of the neat things about bringing it to the retail is there's no reason why retail investors can't do the exact same things that professional mutual fund managers trading firms, et cetera, do, which is hedging. And then the majority of the volume that you'll see on a platform like eToro Options is what we would call speculation. Speculation is about making a trade where you recognize it has a substantial risk of losing value, losing your money, but also has a potential risk for a substantial gain. And in fact, you'll notice that when you sign up for eToro Options, we're going to ask you a few questions in addition to the ones you were asked when you signed up for your stock account, because it is a more complex instrument, and we want to make sure, and the regulators want to make sure that investors understand the risk they're taking, and they've thought it through, and they're comfortable with it. So speculating is definitely about that risk reward on the upside, where you're trying to make an opportunity for yourself to put up relatively small amounts of capital for that nice reward. So let's dig a little deeper into hedging. When you think about hedging, there are two bullets you might think about. I can hedge a single stock or a portfolio. So let's take an example for a single stock. I own 100 shares of XYZ. It's at $100. I bought it at 50, so I have a nice gain there. I've had it for a few years. Now, they're coming out with an announcement next week. Maybe it's earnings, maybe it's a new product, whatever it is. And I'm a little worried it's not going to be good news. I'm worried that investors might think poorly of it, and it's going to drive the stock down. But I don't want to sell the stock. Long term, I want to hold it. And if I sell it, I'm going to have a significant capital gain. So what I might do is I might buy a put option. A put option is when you're bearish, you think the stock is going to come down. And by buying that put option, I'm making money on the put if the stock comes down. So the hedge is my stock comes down, my put goes up, and I lose less than I otherwise would have, depending on the exact hedge I put on. And that itself is a little more complicated discussion about, do I want to hedge exactly dollar for dollar or just a portion of it? Portfolio is essentially the same thing, except I'm looking at a group of stocks. So if I own 20 different stocks, or maybe a mutual fund or ETF, again, the example next week, the new unemployment numbers are coming out. I think they're going to be a negative. I think they're going to make people fear inflation, for example. So I think the stock market might go down. Again, long term, I want to own stocks, but short term, I'd like a little insurance for my portfolio. So rather than buy a single stock put, I can buy a put on an ETF, which is a fund that mimics an index like the S&P 500, for example. And there are many ETFs. There are technology ETFs and international ETFs. I can pretty much mimic any kind of portfolio I want to. And buying puts on those ETFs would help insulate me from the sizable loss I might take if the market came down, because my put would be earning profit while my stocks are losing whatever I have invested in them.
Gotcha. So I want to just sit on this for a second, because this is kind of critical when you think about portfolio strategy. What you just explained, Davis, is basically systemic and unsystemic risk, right? Because on the left side, hedging the stock, you're thinking about catalysts or things, events coming up that could affect the stock, but not necessarily your whole portfolio. So you use options to hedge a stock, and we're talking about earnings events. We're talking about key man risk, the CEO leaves, or some big management, somebody up in the C-suite leaves. We're talking about regulation that might be more industry or company specific. And on the right side, I love that we use the unemployment numbers, because that's something that can impact the whole market. That's something that can tell us more about the economy and change the market's mind on where the economy is going. So I just love that you threw this slide in, because it really gets to the heart of portfolio management and understanding the risks that you're taking on and how you can deal with them, essentially.
And it's funny you mention unemployment, because right now that's a real hot button issue. And I've been in the market for a long time. There's always a hot button issue. It might be what the deficit is, it might be what the foreign trade is, but there's always something that the market is looking at, maybe a few somethings. And if they go the wrong way, the market gets crushed. And if they go the right way, the market does great. So that's really good examples. And obviously that's what you do all day, every day in your research for the firm. Yeah.
So the TLDR is two different types of risks. Keep them both in mind. Options can help you deal with both of them.
Exactly.
Before we go, yes. All right. So before we go on, Davis, I have two questions for you. So we have a question from Ken. Hi, Ken. Thank you for asking a question. Ken asks, can you explain how it works when the option loses value the closer you get to the expiration date. What exactly is that, and how does it work, Davis?
Right. So here's a really simplistic example, and it makes sense. One of the cool things about options are they're complicated and they're risky, but when you break them down into little pieces, they make sense. So think about this. Think about the expiration date. So today is the 22nd of November. So I think that XYZ is going to go up. Now, if I give myself a call option 6 months out, all the way into May, I'm giving myself a really long time for XYZ to behave the way I want it to behave. Or I can buy an option that expires next week, in which case I'm giving myself a very short window for that option to behave or the stock to behave the way I think it will. So it's just logical that for that long window, it's going to cost more. And again, that goes into the pricing of the option. One of the Greeks, theta, is a measurement of the time value of that option. And one of the interesting things is if you look at a chart, and you don't have to, but if you were to look at a chart, theta drops like a rock as you get near the end. Those last 2 weeks before the option expires, the time value of that option go away really quickly. And this is why I mentioned earlier, if it doesn't do what you thought it would, if you bought an option and whatever event you were predicating your investment on didn't happen, sell it, because that time value will eke away the value of it. But if you still have a few weeks or a month or two, you're going to have time value. You're going to have money you can take out to reinvest. So great question, and one of the really important factors in the cost of an option and your thinking about when you decide to sell.
Definitely. It was a great question. And we're starting to learn about the Greeks. Look at us. All right. One more question, and then we'll move on, Davis. So we have a question from Adam. It's a great question. I already know what the answer is, so I'm excited to hear what you say. Adam asks, does eToro offer any fake options for learning, like paper trading options?
We absolutely do. And I'm going to ask you to put your question on hold because I have a slide that actually talks about it and how you might use it. But yeah, I mean, options are complicated. And when I learned them, I used to write down pen and paper, a stock price, an option, and I would follow it for a few weeks to get my arms around, how did they relate to each other? What actually happens in the world we have today? It's part of the app, and it's a really, really important feature because you don't want to invest in things you don't understand. So if you have an opportunity to do paper trading, to practice, to do examples, really, really urge you to take advantage of that and get comfortable before you start investing real money. Great question.
Definitely. So stay tuned, Adam.
All right, let's talk about the other reason people use options, speculation. And we've touched on a few of these already in our examples, but basically we're looking at triggering events. There's something you think is going to happen that's going to cause that stock to go up or down, or an ETF to go up or down. I think I'll just mention ETFs real quick. ETFs, again, it's a portfolio. You can buy them on all different types of markets. And if you think that there's an industry that's going to go up or an industry that's going to go down or a region of the world that you think might go up or down, there's an ETF that matches that and lets you speculate not on a single company, but on a group. And for many of us, we have a much better handle on that than we might on picking the particular stock or particular company. So ETFs are a really good use case, and I urge you to look at them as well when you're looking at using options. So the triggering events for speculating, these four events are probably 90% of why people trade options. Earnings announcements are big. Option volume will always shoot up during earnings season in general, and the day for any particular stock or ETF or stock, the day that they come out with earnings will be a big option day because people are making the speculating investment that they will be good and the stock will go up, buying calls, or poor, buying puts. Product announcements or company news, exact same thing, right? Apple comes out, not investment advice, Apple comes out with their announcements every quarter about how many iPhones they sold. That announcement is watched really carefully by people who look at that stock, and many people will speculate with options on what they think that sales number might be, good or bad. News on competitors. It's not just the competitor, but the rest of the group. So if an auto company comes out and says, we had real supply chain problems, we sold many fewer cars than we thought, our revenues are down, our earnings are down, there are many investors who might think, well, if that company had that issue, I bet other auto companies are going to have the exact same issues. And based on what the information was, they'll go make that speculative investment, buying puts or calls based on what they believe other auto companies will find. And then finally, we just use this a little bit with our unemployment example, is simply economic news that will affect the whole market and obviously individual stocks as well when that news comes out. So when you think about speculating, it comes back to what we've been talking about, setting up the foundation of the trade you want to make. Which direction do I think it's going to go up or down? The date by which I think it'll occur, the amount, the change I think I'll see, and then you pick that contract for that speculative investment. And I want to hit on percentage for a second now. I'm a big believer that when you think about investing in general, thinking about percentages is much more important and easier than thinking about dollar amounts. Because the fact that a $10 stock went up $1 is very different when a $100 stock went up $1. 10% is different than 1%. So thinking about percentage change, particularly with options, is a good way to think about making money, losing money, making investments. You always want to keep that in the back of your mind and try to translate the dollars into the percentages. All right, so let's get specific about our platform, eToro Options. When we started eToro Options, our founding philosophy, the thought process was very simple. We wanted to create a user interface using plain English, not buzzwords, to help walk through setting up a trade. So if you know what you want to do, the platform would be the one you want to go to help you do it. So I've been talking again and again about this idea of asking and answering those questions. What stock, which way, et cetera. So the idea is we built a platform that if you've answered all those questions and you know what you want to do, and I'll show you in a few minutes with an example, the platform will walk you through how to do it. And we think this is our strongest set of features and benefits. It's something anybody can understand in plain English. There are no commissions for trading. We give rewards back to clients for trading they do on the platform. Now, many of you might have heard of PFOF, payment for order flow. It's an industry standard practice. Over 90% of the broker-dealers in America do it, where we take orders and we send them to executing brokers, wholesalers they're called, and those wholesalers actually pay us for each contract they execute because they're trying to trade on their side and make their own money. Well, we take that payment that we get and we rebate a nickel on every contract back to our clients. So early each month, eToro option clients have money put into their account based on how many contracts they traded the previous month. And I think I'm safe in saying there are no other platforms that do anything close to that. Customer support, right? Back to that foundational idea of this platform was built for people who are not experts at option trading, not sophisticated option traders. We think customer support is really important, both the quality in terms of the answers you get and our ability to get you comfortable with what you're trying to accomplish. And secondly, timeliness. There were stories I know historically about how long it might take a customer of a retail brokerage firm to get a response back. We think timeliness is really important, and minutes and hours, not days, is what we're shooting for when you ask a question on our platform. And finally, just a note, we talk about expiration. eToro will try to sell any in-the-money option on expiration day at 3:30 every time it expires. So if you have forgotten about an option you bought and it's in the money, we'll actually sell it for you. And that's actually a pretty common practice in the brokerage industry, and important to know that even if you forget, 99% of the time that option will be sold for you. And now, I think it was Eric. I want to mention the draft trading. Kevin.
Pay attention, Adam, right here.
Adam, I'm sorry. The draft trading feature. So again, really important. It's similar to what they would call virtual portfolios within the traditional eToro world. They're basically identical to the real trade you do. The only difference might be a small difference in price because it actually didn't go to the market, and you never know till you send the order into the market exactly what price you're going to get. But the draft trade, you go through exactly the same process as if you were going to invest, exactly the same. And at the end, you'll see in the upper right side of our screenshot, it says the word draft with a little red ribbon. Instead of swiping up on my screen, which would send the order to the market, I click draft. That trade is now saved in my portfolio. and I can follow it every day or intraday even and see how much profit or loss that trade would have had in it and why that happened. So I can't express enough the importance of draft trading until you get comfortable and start wanting to invest real funds.
So Davis, by the way, like I said, this is a really, really cool feature. And even I, like, for real, am trying to wrap my head around it and all the ways that I could use it in my own portfolio. So in draft trading, the way that you just explained it, you can see your draft trades alongside your real trades and how everything is kind of moving in tandem or opposite. That's really cool.
Exactly. You know, it helps you. There are certain things that are hard to understand with option trading. For example, the stock is 100. How is the option at 110 going to behave different from the option, the call option at 110, the call option at 120, the call option at 130 as that stock starts to move? So putting on a few draft trades that are similar but different help you understand, is it worth it to pay more money in premium to get the strike price closer? Or maybe I'm happy to pay less money and hope my stock moves enough. But it really shows you exactly what the reaction is based on what the stock is really doing in the market. And it's live and updated all day, every day. So it's just like a regular trade. And to Callie's point, sophisticated traders use it too. If you want to test out a spread trading strategy, for example, it's not always obvious, exactly what's going to work and how. So pro traders do things like this all the time before they put real money to work.
Yeah. Ooh, great point. Pro traders, they're just like us, except a little different. But you know what? One idea that I got from that, testing out different strike prices if you're trying to hedge around an event, that's great. I'm going to take that away. I'm going to think about that with all the events coming up, Fed meetings, CPI, all of that. So I'm learning a ton, Davis.
That's the idea. All right. So let's go through a trade. We've been talking about it. Let's see what it really looks like. So when you're setting up a trade, you would start on this screen, the left side where it says Explore. On the bottom right, you can see the picture of the magnifying glass. You touch that, and it would bring up the Explore screen. You've got a watch list, any stocks you're currently watching, eToro's trending list, which will show you the 10 most active options on the platform over the previous 24 hours. And by putting a ticker into that search bar, and I'm going to use Meta, no investment advice, I'm going to use Meta as my example today. So we put Meta in, we go to the next screen, and now we can see Meta. We have, if you look on top, this is the overview look. You can get the social feed on eToro options, which is a feed that tells you who else has been, how many people have traded Meta and whether they've been buying puts or calls and at what price over the previous few days. News will give you any news on Meta. Stats will give you some basic financial information about Meta. We see the chart. We can also look at a candlestick chart, and we can change the time frame from a day up to 5 years. So this is just giving us kind of a feel for that stock and where it's been. And I'm going to hit the trade button on the bottom to get to my next screen, which now sets me up to choose, do I want to buy a put or do I want to buy a call? And in our example today, we're bullish on Meta. We think it's going up. This is, I think I set this up a week or two ago. Meta had taken a big hit in the market, went all the way down to 96. And I'm thinking it's going to bounce back. It's a good company. I think maybe the market overreacted, so I want to buy a call. So I click on call, and that takes me to our next screen where I start setting the trade up. And here you see all the words we've been talking about. So first, I'm going to pick my expiration date. How long do I think it will be before Meta moves? I think in the next month or so, by mid-December, it's going to make a move back. It's going to bounce. So you can see expiration date 12/16. There are, for a stock like Meta, for a very popular liquid stock, there are going to be dozens of expiration dates all the way out months and months and year. Next, I hit the arrow key on the bottom right. I'm going to choose a strike price. How far up do I think Meta will go? Another critical decision, as we've been talking about. The stock currently is at 108.34. And if you read the top, if you can see those words, it says, to at least what price do you think the stock will move from its current price of 108.36? And I mention that because even if you forget, and you will, a lot of what I'm talking about today, the first time you go to do a trade, the app will literally walk you through by asking you those questions. So it's asking me now, how far up do I think it's going to go? I picked 120. And you'll see under 120, 10.74%. If it was a put, it would be a negative number in red, how far down I thought it was going to go. And this is important back to the idea of thinking in percentage terms, because you want to think about how realistic is it. One of the reasons options are risky is when you're wrong, you lose your whole investment. And what I don't like to see are people who make investments that are unrealistic. If I picked 160 and I needed a 40% or a 50% move for me to make money, that probably won't happen. There's a very low likelihood. It's very high risk, and I don't want to do that. So I want to think through how realistic is it that the stock might move that much in that time frame. 10% is actually not bad. It's pretty realistic to me. We've got some other information. The current bid ask. The ask is what you pay on the market when you buy, or actually you usually do better than the ask, but that 243 number is about what it's going to cost me to buy this contract. And below that, I can see my daily change. And this option, when I looked at it, was up 81% that day. So this must be a day that Meta popped. And I see a break even. And you'll notice the break even, 122.43. That's a really important number, because even though I'm buying the 120 strike price, for me to break even on the investment, I have to make back the premium I'm spending, $243. So the break even tells you where the stock price has to go for you to break even. Because if it actually goes to 120, I'll lose money because of that premium. And then after I click on that arrow button, I'm going to get my final question, which is quantity. How many contracts do I want to buy? And I chose to buy 2. They're $243 each. So my total number, you see in red, the minus 486, that's the cost. Give or take a little. When you go to the market, it might change. But that's the cost of my 2 options. And it gives me, again, that break-even price and an if this, then that example of 123 or 124 below that, and how much money I'd make if the stock went to those prices. So it's really painting a picture for you. If I don't lose the investment, but I won the investment because I picked the right direction and the right strike, here's the kind of return I can expect. Now, once I've answered those 3 questions, I'm done. I go to my next page, and I've got what we call a trade ticket. The trade ticket summarizes everything we just set up. It's going to tell me the stock, whether I'm buying puts or calls, how many, what the expiration date is, what the current bid offer is, and how much I'm going to pay. It's where I would set my limit or market order, depending on which kind of order I wanted to put in. I'm going to set whether I want the order good just for today, or what we call good till cancel, where the order can sit in the exchange until it trades. And finally, the estimated total of the trade back to that $490 number. And then up in the upper right, look at that little bubble, save as draft. So here I've got 2 choices. I can swipe up on my screen, and I'll be sending my order to the market, where it won't be quite instant, but almost instantly in this case. I would get a little bar back, a little notification back telling me I bought them because I'm willing to pay the offering. Or I can click on Save as Draft. In that case, it's now in my portfolio, and as we discussed, I can simply watch what it's doing and where it's going over time. And that is how you do an option trade.
All right. So that was super easy to understand, Davis. I love the platform and just how simple and crisp it is. I want to go back to this concept of break even, though. Thinking about what gets somebody back to break even after they make a trade, it's essentially what they paid for that option, right? It's you paid X amount of money for this option to break even on it. Your option needs to move up to this price to get you that money back. And it can move further. It can move further, but we're just talking about getting our money back there. Or am I understanding that correctly?
Absolutely correct. That's how break even is, as it sounds, break even. You didn't make anything, you didn't lose anything, you get to walk away. And, whew, I didn't lose anything.
Yeah. So that's like the target. And I say target in a very non-promissory way, I promise. But that's almost like the kind of equal ground.
That's right.
Gotcha.
That's exactly right. And again, I mean, you always want to think that through when you're making the trade, because you want to try to do something that you believe is realistic. And if it's not realistic, and sometimes people do that, it's a lottery ticket, at least you know it. And that's where those percentages really help gauge if this, then that. If I buy this option and the price goes there, here's how much I'll make or I'll lose. And you always want to think that through before you make the trade, setting expectations for yourself and doing that internal check. Is this realistic?
All right. So good piece of advice. That is not financial advice. Watch your break-evens. Never financial advice. but life advice. Watch your break evens. All right, so I want to remind everybody, one last reminder, we are answering questions in just a minute. So if you have any questions about how options work, the basics of options, eToro options, the platform, please, please, please drop them in the chat. Before we hop into it, I do have a question from Ken. Hi, Ken, again. Ken asks, just for clarity, just to make sure I got this right, the trader on eToro options has to the close of market day to execute their option on the expiration day.
Well, to be honest, we sell anything that's in the money starting at 3:30. And the reason we do that is we want to make sure we don't have clients who we don't know what they're thinking and they're not paying attention, and they would actually end up taking what would have been a valuable option and letting it expire. So that's why we do that every day at 3:30. And again, that's pretty common brokerage practice. You can send a message manually and ask our customer service desk, can you hold that for me a little extra time? And that is something, if we can, we will do that. Some days it's just too busy and we can't. On quiet days, we do that on occasion for clients. But essentially, the expectation is anything in the money will be sold at 3:30 on expiration date.
So basically, and tell me if I'm wrong, Davis, if you forget, eToro options will do it for you.
Yeah, and if you forgot and at 3:45 you go to your screen and say, oh, wow, it's getting closer, but oh, it's already gone because it'll be gone by 3:45. So if you really want to hold it, you have to ask and you have to get an affirmative answer back. On busy days, we just can't do it because many days there are just too many options expiring for us to manage that. It's something extra we do, or at least we try to do for clients when we can, but not guaranteed at all.
Yeah, nice little perk. Nice little perk. All right. Well, Davis, I see the thank you slide. Is that it? Well, awesome. I'm going to give everybody just another minute as I run through a few more housekeeping things. But first of all, thank you to Davis. Thank you for coming and sharing your wisdom on options and eToro options, walking all of us through what the offering is and how different investors can use it. A big thank you to all of you for coming to watch this webinar, coming to learn about options. We're all nerds here. We love talking about options, and feel free to reach out to us if you have any questions at all. I'm going to see if any other questions come in, Davis, but let's see, housekeeping stuff. So yes, if you're wondering if you can download this, you can. Usually there's a little bit of a buffer between the end of the webinar and when you can download this, when it's available for download. It can be up to 2 weeks, but we usually are able to turn it around in a few days. So yes, answer is yes there. And if you have any questions about the webinar, please, please, please reach out to me. I'm at Callie, CALLIECO at eToro.com. And finally, please, I'm seeing in the chat that we have a few questions. Let's see if we get them in the next 30 seconds.
I've actually got a couple of things to add. First of all, thank you so much, Callie. That was a great job. It's great to have such a knowledgeable moderator to help explain things and walk us through. But I mentioned a little earlier that the eToro does a great job with education, and they do a great job with various pieces of information on the eToro site to help educate clients about all different things. They've building up, a terrific library of videos and thought pieces about option trading, defining the put, defining calls. I saw one the other day that Danny, who often moderates our webinars, did about the Greeks. It's the best thing I've ever seen on Greeks. In less than 4 minutes, he walks you through each of the most important Greeks and what they are and how they work. So if you're really interested, it is well worth watching Danny's videos. I'm not sure if they're all online yet. I know we've been building that library up, but they'll be there soon. And the other materials that the eToro educational team has put together, they're really, really good. And outside of eToro, I'll give a plug to Investopedia. Investopedia does a great job explaining pretty much any financial term that you have. It's free, it's quick, and they do a really good job explaining. Another great resource.
Yeah, second that. eToro's education is second to none. Yours truly works on a little bit of it, so I'm a little biased. But eToro has a lot of great options on eToro US's blog. That's eToro.com/news and analysis. or it might just be eToro.com. It's just eToro.com. Cut what I said. News and analysis is where all my stuff is published. That's where all the research is. But check out our educational stuff. It's so, so good. And it can definitely help walk you through, a lot of questions that you'll have after this webinar, once you start trading. And Davis, we actually have 2 questions.
Great.
So we have a question from Philip. Philip says, hi, I joined late. No worries, Philip. Glad you're here. Philip asks, do we need to apply to trade options on eToro?
Yeah, absolutely. On your app, you'll see a button that says eToro options. Pushing that button will set you up to answer a few additional questions. Broker-dealers are regulated in a good way by the regulatory authorities in the states, and there are certain questions we have to ask. The risk level and complexity of options is such that there are a couple of additional questions that we ask to make sure that the investors signing up understand the risk, understand the complexity, and know what they're getting into. But it's a pretty quick process. It's only a couple of questions that you have not yet asked, and then the account gets opened, and then your eToro app will have 2 buttons, one for crypto and stocks and one for options.
Great answer. And we promise the questionnaire isn't too long. Yeah, we're humans here. All right, we have a question from Ranjit. Hi, Ranjit. Apologies if I pronounced that incorrectly, but Ranjit asks, selling the option in the money means someone else will buy that option. So do I get that money, or do we buy stocks for that target price?
That's a great question. So in general, 99.9% of the time on this platform, you're getting the money. Basically, what we're doing is we're buying and selling options. And again, that's why we're doing it at 3:30, so we don't get past 4, because if we bought a call and we got past 4 o'clock and we didn't sell it, we would take delivery of 100 shares of that stock, whatever it was, and we'd have to have enough money in our account to pay for that 100 shares of stock. So basically, the goal here is you're trading the option, you're getting the identical value, but generally, you're not taking possession of the stock. And if you sold a put or bought a put, you're not delivering the stock to the buyer. So you're right that the market participants will buy that and give us the money, and then they'll go out and they'll take delivery of the stock.
Great answer. Great answer. And one more question we have from Ever. Hi, Ever. Thanks for joining us. Ever asks, how many shares of a stock or ETF do you buy with each option? And then a follow-up question, how do you justify a high contact cost if the stock or the share only moved a little bit? So first question is, how many shares do you get with each option? Second question
That's an easy question.
Second question is, how do you kind of reconcile the move that you see in the stock with the move that you see in the options price?
All right, so the first question is an easy one. It's almost always 100 shares. So basically an option contract equals 100 shares, and that 99.99% of the time. I think there might be some outliers, but you don't have to think about that. So you're always thinking 100 shares. In terms of how you value them, that's a really deep, complicated question that there's no way to answer it quickly. But as you saw when we walked through the screenshots, what you're looking at is how much you're investing, and you look at the break even, and you look at the loss and profitability, if this, then that's we're showing you, and that will illustrate if it makes sense. One of the things with options are they can get really, really expensive when it's a volatile stock and a lot of people are involved. So there might be 2 very similar options in terms of where the stock price and the strike price is, but one of them can literally cost the $238, and one of them might only cost $100. And that's because all the factors around pricing that option are different. So it's really an in-depth question that you have to look at a particular setup for to answer accurately.
Yeah, great answer. And yes, every situation is different. And you have to factor in a bunch of different things, including some of the Greeks, which gets a little hairy, gets a little weird. But that's another reason to learn more about options, to understand why they move the way they do. So you're in the right place. All right, one more question. We have a question from Jerome. So Jerome asks, does eToro allow for day trading options or quickly trading options? And then a follow-up question, do you have crypto options?
All right, let's start with the first. And that's a great question. There are day trading rules in the markets that we're in that say you can only do up to 4 day trades. A day trade is when you buy and sell the same stock or the same option in one day. You can only do 4 within a 5-day period before you're what they call a pattern day trader. They, the regulators that we follow. And if you're a pattern day trader, you have to have at least $25,000 in your account in order to day trade. Now, with eToro options, every account is what we call a cash account, meaning you have to have the funds in your account when you buy that option. And you don't have to understand the detail, but what you care about is you can make as many day trades as you want that you have funds for and not become a pattern day trader. And in fact, I know there are quite a few traders on our platform for that very reason, because many option platforms, every option account is what they call a margin account, which means you can borrow money, which means you are a pattern day trader if you do more than those 4 trades in 5 days. So eToro options allows you to do as many day trades as you have the funds for in your account. And that's I'm glad you asked that question. For a lot of people, that's a really important feature of the platform. And once you move to a margin account, which you need for trading spreads, that does change and you can no longer day trade as many as you want. So very good point. I'm glad you asked that.
Yeah.
I'm not sure what quick trades are. Do you have any feel for what that might mean, Callie?
I think you just answered it, the day trading rules and the pattern day trading. Jerome, if we didn't, please shoot me an email, Callico, CALLIECO @eToro.com, and we'll get it straightened out for you. And then crypto options.
The only crypto options, or the only thing I could call crypto options, there are a couple of ETFs that focus on the crypto industry, but there aren't crypto options on particular coins, if that's what you're thinking about, that on the US exchanges right now.
Gotcha. Very good question. All right, so that's about all the time we have for questions. Again, if you have any other questions, about the webinar, about future webinars, about eToro options and our offering, shoot me an email, CALLIECO @eToro.com. Again, this will be available for download, so please, please, please check it out. Just give us a few days to get it done. And most importantly, thank you for coming. Happy options trading. If it makes sense for you, if you're qualified, a little asterisk there. But thank you for joining us. Thank you to Davis, and we'll talk to you all soon.
Thank you.